So either you've been living under a rock or you've heard of passive income. And if you've heard of passive income, then you probably know what a powerful wealth building tool this can be. But there's a hidden trap within passive income portfolios that doesn't get talked about enough. And in today's financial prop video, we're going to talk about what that is, what can happen if you fall into it, and how to make sure that you avoid it. If you're interested, listen in as we discuss. Hi, I'm John Norberg, and welcome to the Financial Prop Series. Alright, so if we're going to talk about the passive income trap, it's helpful to know what's meant by passive income. Passive income is usually defined as that which takes little to no effort to receive. It's non-W-2 income typically. In other words, income we aren't receiving from full-time or part-time employment through a regular employer, usually from some form of activity that takes very little effort to maintain, hence the passive in passive income. A couple of examples would be rental real estate or royalties or dividend income, just to name a few, right? Now, what is the passive income trap? Well, it's basically when you don't pay enough in taxes on the income that you're earning. Now, if you liken passive income to an orchard, when you go to plant an orchard, and this doesn't get talked about enough, the level of work involved in the upfront is often far, far under discussed versus the benefits that can come along if you do it right, which is to collect income with little to no effort, right? But when you go to plant an orchard, you're doing backbreaking work, digging those holes, planting the saplings, watering them consistently, making sure they don't die. But if you do it right, you're going to have this big, beautiful orchard that you can collect a harvest off of year after year after year. But because the U.S. tax system is designed on a pay-as-you-go basis, in other words, as you earn income, the IRS expects you to pay into the system, then you need to be aware of how this income is taxed, because that's the trap. If you don't pay taxes or you don't pay enough taxes, then you're going to face an underpayment penalty. And that trap is one that I think most, if not all of us, would love to avoid. I don't know a single person who loves getting penalty notices from the IRS, right? So how do we know if we should be paying them and how we should be paying? Well, you'll generally face a penalty if you owe $1,000 or more after you subtract any withholdings and credits from your tax bill, or if you didn't pay at least 90% of your current tax or 100% of your prior year's tax in estimated payments. By the way, if you've got a really successful passive income portfolio, it means you have an AGI, adjusted gross income, of over $150,000, then you're going to need to pay 110% of your prior year's tax. Okay, so now that we know what that looks like, let's talk a little bit more about certain types of income and how they're taxed so that we can help figure out what we need to pay through those methods. So I'm going to name 3 examples and how they're taxed. So let's talk a little bit about dividends. Obviously, as a financial advisor working in stocks, bonds, and index funds, I work in dividends all the time, right? Dividends have 2 types. There's qualified dividends and non-qualified. Qualified dividends are taxed at long-term capital gains rates, which is, depending on your income, either 15% or 20%, usually pretty favorable, right? Whereas non-qualified dividends are taxed at ordinary income rates, which is anywhere from 10% to 37%, depending on your federal income tax bracket. And usually you need to tack on some state tax to that, although maybe you're lucky enough to live in a state that doesn't have any income tax, so all you have to worry about in that case is the federal level. All right, so now that we've talked about dividends, let's talk about income from media. So this could be YouTube or maybe online courses or something of that nature. In this case, it's going to be taxed at your ordinary income tax bracket. So you need to figure out where do you lie in that tax bracket scenario and then make sure that you're withholding according to that or making quarterly estimated payments, right? Let's finally address income from rental real estate. This is a really popular one, and again, it gets talked about a lot. Rental real estate income is typically going to be taxed at ordinary income rates, but along with that, there are a lot of deductions that you can take advantage of as a rental real estate portfolio owner. A couple of examples could be bonus depreciation, or maybe you have a cost segregation study done that allows you to depreciate not just the property, but each individual component of the property, everything from refrigerators to doorknobs. at their own rate, which typically ends up in a much larger depreciation deduction, right? Allowing you thereby to potentially roll the funds that you now are not paying in taxes into a new rental real estate property, and thereby building that portfolio more and more and more as the years roll on. So again, rental real estate income oftentimes, almost always, is going to be ordinary income. However, if you liquidate that property, now we're talking about capital gains rates again. There is also depreciation recapture, which is typically at ordinary income rates. This starts to get a little complicated, so if you've got a rental real estate property or two and you're considering, okay, well, how do I make sure I run these from the most tax efficient perspective? This is where working with a good financial advisor, such as Norberg Wealth Management, really comes in handy, because they, working with your CPA or tax team, can really help figure out how do we use this portfolio to our best advantage, whether it be real estate or anything else. So if this sounds like something that maybe you've thought about before, or maybe someone you know is facing right now as their rental real estate or any kind of passive income generating activity continues to grow, then drop us a line, give us a call, email us. We'd love to hear about you and your situation. Click the contact link in the description below, and we'd love to hear more from you. And in the meantime, we'll see you out there.